Okay, let's jump right into this deep dive. Today, we're tackling something I know a lot of you are thinking about: how to generate, steady income from investments, not just for now, but looking out potentially for decades.
Right. And we're digging into a recent article that looks at dividend ETFs as one way to maybe achieve that.
Exactly. And that article points out something pretty important right off the bat.
Yeah, the risk, right? Relying on just one or two single stocks that pay dividends, that can be, well, dicey. If that one company hits a rough patch and cuts its dividend, boom, your income takes a hit instantly.
Precisely. So our mission here is to really unpack how these specific dividend ETFs the source talks about offer diversification. The basic idea is by spreading your money across lots of dividend stocks in one fund, you potentially smooth out that income stream, make it more consistent over the long haul.
Makes sense?
And why should you care? Well, building that reliable recurring income, that's a really valuable goal for a portfolio, but you absolutely need a smart way to handle the risks, especially single stock risk.
And the source really frames it that way. Using an ETF with many dividend stocks is just presented as a more reliable path towards consistent payouts than trying to pick individual winners.
Okay, so this article highlights two specific ETFs. It positions them as kind of ideal buy and hold options for this. We've got the Schwab U.S. Dividend Equity ETF, that's ticker SCHD, and the SPDR Portfolio S&P 500 High Dividend ETF, ticker SPYD.
Right. SCHD and SPYD. Two popular choices in this space.
The source sees these as potential ways to generate income for, decades.
Yeah.
So let's dive into SCHD first. What does the article emphasize about this one?
Well, the first thing that jumps out is it's described as low cost and focused on delivering high dividend payments. The expense ratio they mention is just 0.06%, which is, tiny.
Yeah, 0.06% annually. That's super competitive. That definitely helps keep more of your returns, well, yours.
Absolutely.
And the article notes it holds around 100 stocks, so it's maybe a bit more focused than some super broad, cheap ETFs.
Exactly. And the source suggests that's by design. The argument is that for dividends, you really want quality, not just, any stock that happens to pay something.
Right, quality over just quantity.
Precisely. The fund's whole aim, according to the source, is finding quality companies, checking the sustainability of their dividends, and looking at their fundamental strength. Because a sustainable dividend, that's one a company can keep paying, hopefully even grow, not one they'll slash when things get tough.
Makes sense. And you see that focus in some of the top holdings mentioned, right? Like Coca-Cola, Home Depot, Verizon.
Yeah, established names. You get pretty decent exposure to those kinds of solid income generators through the fund.
And speaking of established, the source gives a breakdown of company size, too. Like 62% are large caps, over $70 billion market cap. Another 29% are kind of mid to large, $15 to $70 billion.
So you're generally dealing with pretty substantial established businesses here, not typically small, risky ventures where dividends might be less secure.
And that probably feeds into its stability. The source mentions a beta under 0.8.
Right. And beta, just as a quick reminder, measures volatility compared to the market. Less than 1 suggests it tends to be less jumpy than the overall market. That can be really reassuring if your main goal is that steady income rather than chasing huge price swings.
Yeah, stability is often key for income investors. The article did note it was down slightly recently, like 2% year to date around the time of the article, but they kind of frame that as not bad considering market ups and downs.
Yeah, context matters there. And the yield they noted for SCHD was 4%.
Okay, 4% yield.
So the overall argument from the source is holding this basket of quality dividend-focused stocks with that low cost and stability, it puts SCHD in a strong position to potentially deliver consistent income for decades.
Got it. So that's SCHD, low cost, focus high quality and sustainability, decent stability, 4% yield. Okay, how does SPYD stack up? The article also likes this one for the long haul, but it takes a slightly different tack, right?
It does. SPYD gives you exposure specifically to the high-yielding dividend stocks within the S&P 500. And the source notes it actually offers an even higher yield right now than SCHD, 4.5%.
Okay, so a bit more juice on the yield up front. And the cost?
Also very low, 0.07%. So another really cost-effective option.
Great. And it tracks an index?
Yeah, the S&P 500 High Dividend Index. So the goal is to hold the 80 highest-yielding stocks from the S&P 500. I think the article said it held 77 stocks as of early June.
And just being focused on the S&P 500, the source presents that as sort of a safety aspect, doesn't it?
It does. They call the S&P 500 a highly vetted index. The implication is, these are generally pretty established, relatively safe.
Oh, interesting. So even within those 77 or 80 stocks, you're not overly reliant on any single one. Good diversification inside the fund, too.
Precisely. And the source also liked its sector focus. It leans pretty heavily into sectors often seen as stable, like real estate and utilities. Together, those made up about 42% of the holdings. These sectors are sometimes considered less sensitive to, economic bumps in the road.
Which could be good for income stability. Makes sense. And top holdings mentioned there were different names like AbbVie, CVS Health, AT&T.
Right. So that's SPYD's approach. Tap into the S&P 500, grab the highest yielders, concentrate a bit in stable sectors, deliver that 4.5% yield. But, and this is a really crucial point the source makes, there's a trade-off.
Ah, okay. What's the trade-off?
While SPYD has that higher current yield, the source explicitly states its long-run total returns have actually lagged. Not just the S&P 500 index itself, but also SCHD.
So more income now, but potentially less overall growth over the long term compared to SCHD or just the broad market. That definitely complicates the choice.
It does. It brings you back to what your primary goal is.
Although, interestingly, the article did mention SPYD's recent performance this year was actually slightly better than SCHD's, down only about 1% in early June 2025.
Yeah, short-term performance can fluctuate, of course.
Yeah.
But the source's broader point about SPYD seems to be that being linked to the S&P 500 is generally good for wealth growth potential. And this fund specifically positions you to capture significant dividend income from within that universe.
Okay, so let's try and bring this all together based on the source. It seems like it presents both SCHD and SPYD as, solid, low-cost, diversified ways to potentially build dividend income over many years.
Right, but with different flavors.
Yeah. SCHD is more about the quality and sustainability of the dividends from its 100 or so stocks. SPYD is about grabbing the highest yielders from the S&P 500 with that tilt towards stable sectors.
But the core message, really, is that diversification you get from either ETF. Holding many stocks helps you avoid that big risk of relying on just one or two companies for your income.
Absolutely. You're swapping that single stock gamble for a more portfolio-based approach aimed at reliability.
Exactly.
So wrapping this up, what's the main insight for you, the listener, from this deep dive? Based on this source, dividend ETFs like SCHD and SPYD look like compelling tools. They offer diversification, low costs, and a way to potentially generate steady income for decades, sidestepping some of the risks of individual stock picking.
Yeah, we saw SCHD's focus on quality, its established holdings at lower beta suggesting stability, and its 4% yield. And then SPYD, targeting high yield within the S&P 500, offering broad internal diversification, focusing on those stable sectors and delivering that higher 4.5% current yield.
Right. But here's that final thought, that provocative question the source leaves us with. SPYD has the higher current yield, 4.5% versus SCHD's 4%. Yet the source points out its long-run total returns have lagged both SCHD and the overall S&P 500. So think about this for your own situation over the next, say, 10, 20 years. What does that trade-off mean? Are you aiming to maximize the income check you get today, even if it might mean potentially less overall portfolio growth compared to another strategy?
It really forces you to consider that balance between immediate income needs and, long-term compounding and total return potential.
It's a key question for any income investor. Well, thank you for joining us for this deep dive.